Hi everyone, welcome to today's video. So right now it is much more inexpensive to buy Credit Suisse Bank's stock over buying Swiss chocolates. I'm not kidding. Take a look at this chart and what you would see is that at one point in time, around 2007, Credit Suisse Bank stock used to cost roughly around 83 Swiss franc. And right now it is trading at roughly 2 francs. So the entire world is panicking because Credit Suisse is one of the largest banks in the world. It is larger than even SBI, which is the largest bank in India. So resultantly, a lot of investors are panicking and they are asking three central questions. Number one, that why is this Credit Suisse crisis happening? Number two, how is this going to impact the broad banking sentiments and the overall economy? And third and finally, what is it that the investors need to keep in mind in order to survive this entire volatility that is going on in the market? So this is the precise piece of conversation that I'm going to have with you. I'm going to break apart this topic in a very simple, easy to understand language. Even if you're a school-going student and have not studied economics, finance ever, I will try to break apart this topic in very simple to understand language. And also one very important aspect to investing is that you need to diversify your bets, because it is precisely during times like this that investors panic, they sell their portfolio, they move away from the stock market, book a lot of losses. Just to avert that, it becomes very important for you to stay balanced when you're investing and invest some money in equities, some money in different asset class. So that can help you avoid panic-oriented situation. For that, you can also check our sponsors for today, which is Smallcase. They come out with wonderful small cases which are very balanced. And one of my favorite small cases is the split between equity and gold. And for beginners who have just started to build their portfolio, taking such balanced approach makes a lot of sense. I will also be linking some of my favorite small cases in the description and pinned comment box. So please go and check it out. So let us kickstart. And the first key aspect that I would like to quickly present is as to why the Credit Suisse crisis is happening. So I had done a video approximately 5 months back on Credit Suisse crisis, and since then it has only accelerated. So in case you want to understand in depth what has happened with Credit Suisse, please go and check out the video. Again, I will link it in the description and comment box. But I know that many of you would not go and check out that video and will miss on the basics. So let me quickly encapsulate the basics in 2-3 minutes as to what has actually happened at the Credit Suisse Bank. So here is the balance sheet of Credit Suisse Bank, and this is the latest one, 2022 one that I have picked. And what you will notice is that year on year, its total asset size has gone down. For example, back in 2020, its total asset were approximately $820 billion balance sheet was there. Now it has come down to $351 billion. So a natural question comes that, okay, aisa kya ho gaya that, you know what, such a big bank, $531 billion of balance sheet, why is it shrinking and what is exactly happening? So the first and the most important aspect that has hurt Credit Suisse's credibility is the loss of investors' trust. Now, why has that happened? In order to understand that, let me quickly explain you the Credit Suisse banking model. Now, just for context, Credit Suisse is one of the biggest banks in Switzerland, and Switzerland as an economy thrives on secretive banking. Secretive banking means that jab घपला करके लोग भागते हैं, when they are like corrupt, and once they run away after doing corruption in a particular country, they go and deposit their money in Switzerland. Now, this is not an allegation from my side. This is widely known, and a lot of people believe that banks like Credit Suisse, they run like wealth management practice, and they have a fairly big wealth management practice. So exactly what happens in this wealth management practice? So you have HNIs. What they do is that they give their money to banks like Credit Suisse, wealth management arm. Credit Suisse takes that money and goes and loans it out or make investments on their clients' behalf. Now, if the loans that are given out, if they are able to collect it back, or if they are able to grow the investment, then these HNIs eventually benefit. Now, if you take a look at this particular chart, you will see that the stock price of Credit Suisse was gaining new momentum and was gaining new height up until 2007. Why was that the case? Because up until 2007, the regulators were a little bit relaxed. They were not scrutinizing the banks very properly. They were giving like a lot of lax treatment to banks that, okay, jo karna hai karo with wealth management of your client, this, that. So banks like Credit Suisse made a lot of money. Then 2008 crisis happened and the entire world's banking system somewhat collapsed, so to say, and there was a lot of scrutiny, especially on large banks like Credit Suisse. And therefore you are seeing that after 2008, the downfall of Credit Suisse happened along with a bunch of other banks. And the number one reason there was that this entire wealth management practice got hit very badly, because the way these companies or these banks used to invest money in terms of loans or making substandard investment, that bit was curtailed by regulators. Then you might have a natural question that, okay, this was a system-wide regulation that came in. So why is it that Credit Suisse or a bunch of handful of banks started getting more impacted with it? Well, Number one reason was that its wealth management practice was really big. The second reason had to do with the internal dynamics of the bank. For example, a number of CEOs were changed in a quick succession, so there was less management stability. A related point here was that Credit Suisse management made a lot of shady investments. For that, you need to understand the story of Greensill, which was one of the invested companies of Credit Suisse, and that particular investment became entirely dead and the company went bankrupt, and Credit Suisse ended up losing a lot of its clients' money. So as a result, there was erosion of trust and a fast downfall of its wealth management business. Now, losing their investors' money was not the only thing that Credit Suisse was dealing with. They had made a bunch of violations with the regulators and had to pay heavy penalty. I can't even count how much money is this. So you tell me in the comment box. And the total number of violations that they did were approximately 50. So this is a fairly high number of violations. So to cut the long story short, this led to the downfall of Credit Suisse. And now we have reached a situation where its net revenues are constantly going down. Its net assets are constantly going down. So these are not healthy sign for a large prominent bank that once used to be the apex of the Swiss banking system. It is completely collapsing. The final nail on the coffin was the Silicon Valley Bank collapse. So two major American banks have recently collapsed. So as a result, investors started looking at the fissures that were erupting in other banking systems across the globe. And they again revisited the story with Credit Suisse, and they said that, you know what, okay, American banks going down. Let us look at Credit Suisse and whether they can pay their creditors back or not. And people started putting questions on Credit Suisse. So as a result, the Swiss central bank had to infuse a liquidity of roughly $54 billion in order to infuse liquidity in Credit Suisse bank. So if you have understood the crisis, now you will say that, okay, theek hai yaar, crisis bach gayi. And you know what, India is also saved. Stock market also did not fall much. American crisis also seems to be over. European bank crisis also seems to be over. So sab kuch changa si. No, that is completely incorrect, because now you need to revisit the number $53 billion and the other collateral damage that other European banks might suffer. So Credit Suisse is not the standalone bank that was having problem. A bunch of other banks also had exposure to Credit Suisse, and there was a little bit of erosion of trust with those banks also. So anyways, coming to this figure of $53 billion only. Now see, where do you think this money is coming from? Is it like free money that, you know, government, it decides to print whatever money and they give it to like Credit Suisse Bank and that crisis is over and everything is good after that? The answer is no. By now, we all know that whenever the government decides to print money, it leads to inflation from mid to long term. Very similar story played out in 2008 also, when the US central bank printed a lot of money and gave it to American banks that here hai paise, right, and go and save yourself. Okay, great. They saved themselves. Everyone thought that, okay, crisis is over. No, it transpired into higher inflation. Something again very similar happened in 2020 that, okay, stock market fall, COVID crisis, this, that. Government again turned on the printer and again there was persistent inflation. So this $53 billion that you're seeing, what will this definitely lead to? It will lead to higher inflation, where especially in Europe, which is already dealing with very high inflation to begin with. Now they have taken $53 billion more and have given it to banks. Now this will come back and hurt the common people more who are already reeling under inflation. Now an added point here is that there is nothing wrong with the ebb and flow of inflation, that sometimes the inflation will go up, then it will come down, then it will go up, then it will come down. Nothing wrong there. But the situation from 2021 onwards has been that inflation has been rising, and a lot of work has gone into by the central banks and central government in order to control this high rising inflation. Now what has happened is that another injection of $53 billion have been injected in 2023. At a time when inflation was already high. So this creates a little bit of problem. So now you might have a natural question that, okay, what is the precise problem in terms of doing that? Yeah, jaise abhi tak printing hoti aayi hai, and again more printing will happen every time it gets solved. So what is so different about this? Okay, so there are two things at play. So number one thing is that right now you might have noticed that interest rates in the economy have been rising, not only in India, in the US, in Europe, everywhere. The central banks have started to increase the interest rate quite aggressively. I'm not just saying like a gradual rise in interest rate. Take a look at this chart and you will see how steeply the interest rates have risen. Now what has happened is that now, due to banking panic and with a loss of investor sentiment, so to say, what is this going to do? This is going to dent growth. Now in such an environment, if the banks or central banks all across the globe, they keep on raising the interest rate, then what is that going to do further? Well, it will derail the growth further. Now this is something that the governments all across the globe are trying to prevent. So therefore, some macroeconomists right now are predicting predicting that the governments all across the globe might in fact cut the interest rate. Or the second scenario is that they might keep the interest rate flat. So let me very quickly show you Dr. Raghuram Rajan's commentary on this topic. So I will play this clip and then I will share my understanding.
My sense is, as far as the interest rate measures go, the Fed is unlikely to back off and cut rates at this point, given what it knows. But I think it is probably going to be thinking 25 or 0. And, events till next Wednesday will determine which one.
You understand.
So Dr. Rajan is of the view that the Feds might not accelerate the rate. They might keep it flat. So you'll say that, okay, isme kya problem hai if they are keeping the rates flat, at least they are not cutting it. Okay, so let me give you a parallel example there. So let's say that, you might be having friends and they are trying to build muscles in the gym. Now, there are two ways of doing it. One is the hard way, that you go to gym and, show up every day and, pump weights and for years and years, and then you get muscles. Or option two is that you start taking steroids, and that way your muscles will develop very, very quickly. And let's say that you have taken too many steroids. Now your body is like bulky and doctor has told you that you need to take care of your health. Then what do you need to do? You need to eat clean, you need to stay healthy, you need to probably take natural products and not use steroids again. If you use steroids again, it is going to be very, very harmful for your health. So same thing is happening, that cutting the interest rate is like using steroids for the economy. That okay, once in a while, if you just want to prevent the shock in the economy, it's okay to bring down the interest rate. But if you keep on doing it over and over and over again, it just deteriorates the health of the economy. So now, since the world economy was recovering from 2021 and there was a lot of pain associated with it. Why? Because of high interest rate, that the governments had to increase the interest rate. Why did they have to do it? Simply because of the fact that they wanted to preserve the health of the economy from a long-term perspective. Ki bhai, heart attack hi na aa jaye economy mein. So they were on the path of undertaking that course of treatment by increasing the interest rate. But now, because of this banking crisis, it is seen by a lot of economists that A, they might cut the interest rate, or B, they might keep it flat. So right now, both these options are bad considering the long-term health implications on the economy. So I hope this simple example helped you understand the entire context as to what is happening. Now, to understand slightly more detail, I'm presenting very complicated macroeconomics. I hope you are able to grasp it. And if you did, do press the like button. It will support these type of videos to reach out. The second commentary has to do with the asset liability of what the central governments currently hold. So for example, this is a statement from Robert Heller, who is the previous Fed chairman. Please listen to it and then I'll explain it.
And they lost a lot of money on these long-term treasury securities. The Federal Reserve has assets of about $8.6 trillion on the balance sheet. It has, liabilities of about $8.6 trillion. It has assets of 7.4, and so it has a negative net worth of about $1.1 trillion because it did exactly the same as Silicon Valley Bank did. Or let's put it the other way around. Silicon Valley Bank did exactly what the Federal Reserve did. And therefore, they both took the losses as interest rates went up.
So basically what Mr. Heller has said is very simple. That's see, the total liabilities with the Central Bank of America is roughly $8.6 trillion. Their assets are worth $7.4 trillion. They have invested in a way in long-term maturity bonds. Now, if you actually understand the Silicon Valley Bank crisis, again, I had done a separate video. Please go and watch it. You will understand a lot of macroeconomics. So it is exactly similar. And there was a tweet also that I had done on the same topic that this entire mechanism is very similar to how Silicon Valley Bank collapsed. That people were asking for their money back from Silicon Valley Bank. They were unable to give it because they had liquidity concerns. This balance sheet of the Central Bank of America portrays that same liquidity crunch and the loss or the notional loss that they are facing in terms by investing in bonds. So theoretically, if the American people actually go to their central banks and demand their money back, they will not be able to get it. You will say that, okay, how do people demand their money back from their government? ऐसा तो मैंने कभी सुना ही नहीं है. So take a look at any Indian currency note, you yourself will see that it says very categorically that I promise to pay the bearer a sum of 100 rupees. So any government that prints money, that money represents a liability. So to cut the long story short, right now we are in a situation where America's total liabilities are in excess of their assets, and some of their investments, or rather a large chunk of their investments, have become bad. So to cut the long story short, this is where we stand, that number one, banking crisis is derailing the trust of a lot of people, lot of investors. People are asking for their money back. Number two, the central banks and central governments across Europe and America are deeply stressed. And third and finally, the economic growth prospects of the world looks bleak. Now you'll say, Akshat, you have become bearish. You have changed your tune. You are a dogla person. No, please let me explain it to you by again taking you to one of my tweets. And again, a humble request that if you like my content, do follow me on Twitter. I write a lot of interesting stuff there. So taking back to this tweet. So basically, if you ask yourself why the stock market in the last 20 years, that if you take Nifty returns and all the stock market investors, they keep on saying that Nifty 12% se grow karta hai, 12% growth, this, that. So where does that 12% growth exactly come from? Well, historically, 7% GDP growth happens in India and 5 to 6% inflation. That is official. So that 12% leads to stock market growth. Now, I'm not saying that stock market growth will come down, but what is going to happen is that inflation will be like 7 to 9%, but the GDP or forecasted GDP will be roughly 3%. So the return will still be 12% from stock market, but a lot of that real return, what you are making, it will be eaten by inflation. So this is the world we are moving towards, that we will see a significant period of inflation, and a lot of people will unfortunately fall from middle class to lower or poor segment. That is definitely going to happen. So is there something that you and I can do as normal investors? So this video has already become big. I will make a separate community post tomorrow explaining some of my strategies as to how you can deal with inflation and what type of investments you can make. But just to quickly summarize some of these steps that you could start taking. So here are 3 things that I will suggest. So first and foremost, you must learn how to survive in a sideways market in case you are a stock market investor. Now, what exactly is a sideways market? So for that, let me take you to Nifty 50 chart, which indicates the entire sentiment of the stock market. And what you will notice is that right now the markets are trading at 16,900 levels. This level existed back in September of 2021. So approximately markets have been sideways for the last 1.5-2 years. Now it is very enticing, and even my theory is that, you know what, the likely run up is supposed to happen. But with these type of banking crisis, what might happen is that we might continue a lot of sideways movement, that we will go in a certain range only, and then eventually there will be some kind of breakout. And therefore it becomes important for you to learn how to trade in a sideways market. So what strategies you can adopt, I will talk about it tomorrow on the members community post, and you can learn more about it. Second key thing, please be diversified across asset classes. Almost all of you who have been regular watchers of my channel, you know for a fact that I invest across different asset classes, and one principle that I've always advocated is that please stay diversified. Please buy some assets where there is limited supply. For example, it could be Bitcoin, it could be gold, it could be real estate, whatever you want to put your money in, whatever asset class you believe in. So again, also you can check out some of these small cases, but please diversify your investment. That is a simple request. Now third and finally, and this might look a little bit counterintuitive, that you and I need to take more risk with our money. Do I like it? Absolutely not. I do not like risking my money. But unfortunately, in a high inflation world, the only way your wealth will be preserved is that you create 2 different categories. One is absolutely safe investments, which you need for survival. Fill this bucket and then move to risky assets that can give you growth. Now, I'm not saying which asset you should buy. It could be small cap, mid caps, whatever asset class you believe in, but you have to invest your money for safety and then take risk with your growth money. I feel that going forward, Nifty 50 investing is not going to yield very positive results. That is my perspective. Again, I'll make a separate video on that topic. But on that note, I hope you got the entire perspective of how the banking crisis is happening, how it's going to impact the economy, and what are some of the actions that you could start taking. If you enjoyed the video, do share it with your friends, and please press the like button, and I will see you soon on the next video.